Are you struggling with balancing your trading with either a full-time job or full-time education? Because in this video, I have an extremely profitable smart money concept strategy that will allow you to balance your trading with your job, with your career, with your full-time education. The strategy only requires around 15 to 20 minutes chart time every single day, so it's very, very accessible to the majority of people. So without any further ado, let's jump over to the charts so I can introduce you guys to this smart money concept trading strategy. Okay, so this is Euro USD on the 15-minute time frame. And rule number one, so if you're looking over to the right side of the screen here, you can see it is to, number one, identify our higher time frame trend. We do that by using the 50, the 100, and the 200 exponential moving average. Very, very simply, if you head over to the indicators tab at the top of your screen, type in the EMA 20/50/100/200, add that to your chart, add that to your favorites. This is what we use for the directional bias, okay? Once you've added that to your charts, you can see here, if you open up the indicators, you only want to add the 50, the 100, and the 200. You don't want to check this top one, which is the 20. We don't need that, okay? So just the 50, the 100, and the 200, that gives us our directional bias, okay? And you're going to ask, so how do we understand our directional bias using the moving averages? Very, very simple. Very, very simple. The green one is the 50. So if the 50 is below the 100, is below the 200, i.e. they are all in order, this indicates that we are in a sell bias market. Therefore, we are only looking for shorts if this is occurring, okay? So if the 50 is on the bottom, the 100 is in the middle, and the 200 is on the top, that indicates to us as traders, okay, the momentum on the higher time frames is actually to the downside. Therefore, in terms of a probabilistic approach, we are best off looking for shorting opportunities because price is more likely to go to the downside, okay? So, you know, that old saying, right? The trend is your friend. It's very, very simple. So we've identified the higher time frame trend. We've identified that the 50 moving average is below the 100, is below the 200, okay? Next, we want to look at number two, which is to identify a sweep of session-based liquidity during a kill zone. And that sounds quite complicated, but let me just simplify that for you guys, okay? So identify a sweep of session-based liquidity, i.e. we're heading into the London session, okay? So the London session is between 8 a.m. and 10 a.m. GMT, okay? That's UK time, GMT. If you don't know what that is, make a note, have a look at it after this video, 8 a.m. till 10 a.m. GMT, okay? What we want to do is have a look at a sweep of session-based liquidity. So, for example, if we're in the London session, okay, we want to look for a sweep of liquidity in the previous session. So, i.e. the Asian session, right? So that's the previous session to the London session. So go ahead, mark on your range highs of the previous session. Okay, so let's mark that on in a black line. So it's very, very simple. So what we want to see is a sweep of liquidity above the previous session. So we know we're sell biased. Therefore, we want to see a sweep of liquidity above the previous session's high, which is right here. Once we see that, then we can look to engage in a short trade. Okay, so we're looking for price to come up within the London session, deviate above the previous session liquidity. You can also call this time-based liquidity during a kill zone. Okay, so these are very significant confluences that we are stacking together. Okay, you can see we get a sweep of liquidity right here above the black line, which is the high of the Asian session. Okay, and let me just, because I know a few of you guys will be asking this, in terms of GMT from a UK perspective, that's between 12 o'clock midnight and 5 a.m. This is the Asian session. Therefore, that's the high that we want to see swept in order to engage in any sort of short trade on this market. So once we've seen that sweep of liquidity, we then want to see a bearish print to indicate to us as traders that, okay, sellers are actually looking at shifting this to the downside. We need to see some sort of sell momentum step into the market, because I think sometimes where people go wrong is they're looking to go short based off not very strong confirmations. Like it may be a break of a bullish candle's low, but really, is that actually showing any bearish momentum? Not really, okay? Until we actually see candles closing bearish, that's what indicates to us as traders that, okay, sellers are actually jumping into this market. So number 2, identify a sweep of session-based liquidity during a kill zone, i.e. we've seen the sweep of liquidity, we've came above right here during a kill zone, during the London session, okay? And we've had a bearish print, okay? So in terms of a stop loss, we want to enter on the break of the bearish candle's low that has swept liquidity. So this candle here swept liquidity. So we want to break of that candle's low, then we can go short. In terms of a stop loss, we look left. Can we get in any coverage in terms of fractals? Okay, so if you're looking left here, you've got these sort of fractal highs right here. So a stop loss just above there would make sense in terms of having some coverage on your trade. Okay, so this is the number 3, which is executing the sell model, the market maker sell model. This is number 3. Okay, so we've identified the sweep of liquidity. The sell model in this instance is a bearish candle confirming bearish momentum. Then we can look to short that trade on a break below that low, target above range liquidity right there. And we have a little bit of coverage, as you can see in number 4, which is quantify a logical stop on fractal coverage if possible. So if we look left, can we get our stop, above them fractal highs where the risk to reward still makes sense? Okay, yes, we can. It's only a little bit more above the candle high, so that makes a lot of sense to me logically. And then number 5 is we want to target either a 1 to 2 or opposing liquidity. Okay, so what I mean by opposing liquidity is essentially external liquidity, which is the range lows. Okay, so here you've got range lows at around a 1 to 1.5, okay, 1 to 1.5, or you can target a 1 to 2. Personally, I like to target a 1 to 2. The reason why is it keeps everything very mechanical and very, rule-based in terms of risk to reward. So it's very easy to backtest your strategy, because sometimes liquidity can be a little bit very, subjective. So I think having a mechanical risk to reward makes a lot of sense. So that's personally why I do use a 1 to 2. Okay, and let's play this trade out. And you can see a 1 to 2 was smashed within this trading session. Okay, and this is the Asian session liquidity sweep. You can see here target a 1 to 2 or opposing liquidity. Okay, so let's touch on risk management, because I think this is something that's very, very important, something that's sometimes overlooked. Okay, you want to be risking around 1 to 2% per trade. That ensures you're using correct risk management and you're not over leveraging, over risking, and essentially going to cause yourself some serious harm in potentially blowing an account or anything like that. So stick to 1 to 2% risk per trade. Keep it very mechanical. Either use 1% or 2%. Don't go mixing it up. Stick to one risk parameter, either 1 or 2%. And in terms of risk management, avoid trading multiple pairs with the same currency, because you may be overexposed due to significant correlations. Okay, so either stick to 1 or 2 pairs. Don't go dabbling if they both got dollar cross. So example, Euro USD and USD JPY, they both involve the dollar. They're probably quite inversely correlated. So stick to not over trading with multiple pairs at the same time. So this is the Asian session liquidity sweep. Just to recap what we've got here, it's essentially a 5-step process. We've got identify our higher time frame trend. You may use 4-hour fractals. I like to use the EMAs 50, 100, and 200. Very, very objective rule-based approach. And then number 2, identify a liquidity sweep, a session-based liquidity sweep during a kill zone. So this is this right here. We've got a liquidity sweep above the previous session's high. So this is, time-based liquidity, okay? And this is during a kill zone, during the London session between 8 a.m. and 10 a.m. GMT, okay? Number 3, execute the sell. So the market maker sell model, which in this instance is actually just bearish momentum stepping into the market. Number 4, quantify a logical stop loss, fractal coverage if possible, which you can see we've got right here. Fractal highs were over to the left. Can we get some coverage? Yes, we have. We've got that right there. And then 5, objective approach, target 1 to 2 or opposing liquidity. I like a 1 to 2, very objective, very rule-based, very quantifiable, and that's personally what I like to stick with. Of course, 1 to 2% risk per trade, and avoid trading multiple pairs with the same currency cross because you may be overexposed due to correlation. So let's just head over to the outro of this video, and yeah, I'll see you guys in just... Hi guys, thanks so much for watching. Make sure you join the free Discord community. The link is in the description of this video for more free analysis and access to the free Toto Capital community. Also guys, let me know your thoughts in the comments below, and please subscribe to the channel. Your support is much appreciated. All right, take care guys. Bye-bye.